Hello members, LA here. It is January 25th. This is the weekly review where we take a look at what happened last week, what we think that portrays for the next week or few weeks actually. Take a look at the portfolios, and to some extent we're going to look a little bit farther out this particular broadcast because I want to talk about the risk that really are out there longer term. So we'll be doing that a little bit today too. Last week you had a decent week. We got 2.7% on the NASDAQ. You can see the outperformers was tech, 3% on the week. A big part of that was the big caps where Google came roaring back and Apple. Of course, we got earnings coming up pretty soon, so it's a push into the earnings on those. Industrials also were strong last week, and consumer discretionary. Those were kind of the outperformers when I look at the S&P 500 sectors. Overall, finally, after a very slow start, a lot of weakness, you got to push up. What does it mean? Does that mean, we're going to sky high again, with one of those V-shaped reversals? Well, let's consider that as we go along here. So the technical and the fundamental picture. If I look at these, you have to say the ECB and the QE was the big thing last week. But you also had some good strength in the NDX and the composite, as I was just alluding to, and I think that's what we need to focus on when we're looking at this market from a technical perspective. So if I draw this out and we think about this, right, we really have this huge range that's been going on here, and you can kind of divide it up into two sections like we usually try to do, right? Look for equidistant, areas that give us some sort of a view of that. Well, we're in the middle of the top half, which is nice. That's kind of where you want it to be. Now, if we throw that away and say, okay, what happened last week? The key thing here was we took out this area. Yeah, we didn't have much volume. Yeah, it's not like it's, storming higher with the bulls buying more and more at higher and higher prices. That's not what's happening. But the key thing is you got over it, right? You got over it here, and you also got over it, although it's a little different setup, you also got over it in the NASDAQ composite, the broader composite. That price point, the first leg up off that last push down, if we go back, we've kind of had this push down, then the skyrocket up to new highs in December, then we come down to start the year, right? Then we get a push up that fails and we come right back down, and now we're going back up. Now the nice thing about this is forming sort of a W, which many times can lead to even higher prices. So that's the good thing. The bad thing, well, it's extended, right? It's going straight up again. And we've seen that over and over. But technically getting over this area was a key area, and it held it on Friday. So when I look at tech, tech is usually in the bull market is the leader, and right now tech is trying to take over leadership. That's good. There's no way to say anything other than that's good. And a lot of that good, of course, was off the QE that came out of Europe, and that was particularly last week, that was the driver. Dollar, man, the dollar is a problem though. If I pull up the dollar, and you've seen this over and over now in the earnings that are coming out. I mean, I saw last week and then again this week multiple earnings reports where misses are being blamed on the dollar. And the dollar just keeps working higher. If you look back at last week, you had Canada dropping their rates. You had Great Britain in their notes saying, the two guys that have been voting against, that have been saying, let's pull back, and start raising those interest rates, they acquiesced and said, well, maybe not. That was a big shift. And then, of course, you had the QE in Europe, 1 trillion plus open-ended. Dollar skyrockets, and a huge part of this is the euro, but it's not just the euro. I mean, you're seeing rates, not rates, but you're seeing currencies get demolished again across the board. The Australian dollar, the Aussie, down, right? Great Britain, what we just talked about, right? They're down. Canada, of course, with their rate cut, they get hammered lower. The only one that really isn't pushing down right now is the yen. And it's just consolidating, because if you look at the yen and you pull it across and look at it longer term, yeah, it's doing a consolidation bounce. But where's it going? It's probably going lower still. The dollar on a long-term basis is working back to test this big high over here from June of 2010. Now, if I go back to June of 2010 on the S&P 500, what was June of 2010 back here? That was lows, right? The dollar strength was pressing this market lower back in that time frame. And that in 2011 were the only times that we've had corrections, and we're going to come back to this in a few minutes, since that period. Now, we had an October correction this past year, but as you know, they bought it up immediately. You know, when are we going to get a big correction? I'm going to talk about that a little bit later in the show. But right now, the dollar strength, you know, is an issue. It's an issue on earnings, and I suspect it's going to continue to be an issue as we go forward. Looking at the rest of this, the other thing we have to realize is that oil still hasn't made a complete bottom. So if I pop oil up, new lows again last week, breaks a new swing point low, volume 32.7, 32.06, so it's suspect. That's why the red arrow. If I point over to the OIL, it also breaks with slightly less volume. So again, across the board, oil's not done. Of course, what does that do? That puts pressure on the XLE, and the XLE, of course, you know, divergent in that these companies' earnings didn't look that bad this week, but at the same time, you know, these guys are trying to build out a bottom, but unless oil quits going down, they're probably going to set new lows again, and that's going to be pressure, you know, on the equities, the general equity market. Looking at the positives, right? Well, commodities. Well, let's while we're on this oil subject, look at this commodity chart. This is just the broad commodities GCC. It's continuous commodity ETF. This thing has gone from 25 to 22, so that's, you know, 10-15%. That's across broad commodities. And that's not just oil, that's everything. If I look at just, say, grains, for example, look at the declines in the grains. Folks, commodities are being pressured across the board, all across the board, and is really a function of the strong dollar. I mean, that's what's pressuring all of these, and will continue to pressure them as long as the dollar continues to press higher. So the dollar, not only is it killing the commodity side of the equation, it's also putting pressure on our equities as a result of the earnings problems that it creates for the companies. So, you know, across the board, the dollar is a problem and will continue to be as we go forward. Now, on the positive side of things, right, we actually have some decent positives, and that is that the indexes, they all did retest regenerates and held on the weeklies, and that's true of the indexes and the sectors. And that's going to be a two-edged sword as we look at it here in a bit. Let me pull the weekly over for the S&P 500. So here's the retest regen off this prior swing point high, right? You come into it, you hit it, tries to break it down, doesn't do it, comes back up, tries again, right? Second test. That's about a 60% chance that it's going to move back up and hold, and right now it looks like it's trying to regenerate higher. But it's a weak situation. It's not, there's nothing strong about this, but it did hold. If we look at the other indexes, they're all the same. So the NDX, for example, weekly, pull that one up, you can see it comes back into these highs and holds. If I look at the NASDAQ, right? On a weekly, same thing, comes back into those highs, holds. So from a technical perspective, right, that's a good thing. That's what you want to see. The weakest sectors tend to be coming back, right, and doing some bottom building. And I was just touching on that when I was looking at the XLE and saying, you know, this guy is trying to build it out. But if I look at the XLB as well, and let me pop over to the major sectors and bring up the XLB, here you can see, you know, this is holding in a range. Now if I look at it on the weekly, it's actually holding that upper high, you know, that higher range as well. So if I put the ranges in here and draw them in, you know, you kind of have these three ranges, and it's holding. And it's holding right there, testing, trying to get into the upper half. So the weaker sectors are actually trying to put in bottoms, right? They're doing their base building, which is an important thing that has to happen. And the reason I bring that up is that if you look over at the trends, and let me grab that, it's kind of critical that the weaker ones find support in turn versus the stronger ones continue to get weaker. And so if we look at, say, the financials, they're trying to get weaker. They haven't, you know, broken down yet, but they're trying to get weaker. They're the laggards. But here's your bearish one, a sideways one, another sideways one, and another bearish one. And the two bearish are the basic materials. You want to see them build out bases and try to go higher. You don't want to see the strong ones get sucked down. The way, you know, the way people, or not the way people, but the way the market gets into trouble is that this goes bearish, comes back to sideways, but hangs, can't go back to bullish. And eventually these start to turn. And that is what happened on these weaker ones. They got bearish, they hung, they got bearish, and then eventually they broke down and they you know, went to bearish on this side. That's the danger, you know, where the weakness on the short term leads to weakness on the intermediate term, and eventually if this is weak long enough, you get it over on the long term. We're nowhere near that yet, but it's important that these start to get stronger, and the weakest ones, being the XLE, XLB, are the ones that you do want to see build bases and start to get stronger and eventually go back to sideways over here. That hasn't happened yet. It takes a while, but so far, you know, when I look at them on a short-term basis, they're starting to do that, and that's important to do. The other thing that was really key last week technically, you know, in terms of strength, was the overseas markets. All of them, almost every one of them, are starting to break out. And I'm just going to pop up a few. Here's the all ordinaries over the highs. If I look at you know, India, for example. Now India cut rates, I think, about 3 weeks ago, and they've just been skying ever since. So I mean, think about it. So far this year, India, Canada cuts rates. Britain says they're not going to raise them. QE happens in Europe. Japan's still QEing like crazy. China's been loosening money. What's the next shoe to drop? It's the US, right? And that happens next week with the fundamentals that we'll see here in a minute. So anyway, QE, Asia, Europe soars, technically very strong now. Sure, they can get a pullback. But at the same time, these are breakouts all across the board. So if I look, you know, let me just look at a couple more of them here. Let's go to Europe, for example. You know, the DAX, new highs, just skyrocketing. France makes new highs. Even the FTSE in London's making, or right at new highs on the weeklies. So very strong across the board. And if I go back to Asia, look at like Taiwan, even new highs, skyrocketing. Indonesia, all of them, folks. The Hang Seng, the Hong Kong market, new highs. That's not a bearish picture, and that, I suspect, is going to continue to keep us up once we get over the earnings near term. QE in ECB, the negatives is the earnings really off the strong dollar. What do I watch for? It's the Fed. The Fed's next week, right? That's going to be the key statement, the key piece of information next week. Of course, earnings are still going to matter, but it's going to be the Fed. And what does the Fed do? Do they tend to signal a more, shall we say, monetary easing form, a more dovish view? You know, is that what we're going to see? Are we the next shoe to drop in this whole continuation of earnings, not earnings, but of a weak currency play? Right now, dollar strong. Fed probably is going to do something to try to pull that dollar back in, because if you allow it to just keep getting stronger, it's going to hurt earnings, and that's going to hurt the bull market, and the Fed really doesn't want to see that. So I suspect you're going to see pretty soon, and it could be this week, the Fed come out and start signaling a more dovish tone and saying, hey, maybe we're not going to raise those rates in June or July. The next 2 weeks is the earnings, right? Almost everybody is going to be reported by then. And I think the technical part that you really want to look at is the S&P 500. So if I pull up that chart again, you want to see, I want to see them trade over that swing point high. If they get over the swing point high, we're almost definitely going back to the highs and most likely going to break them. That would be the next leg up. And so I think the S&P earnings are going to be key this week. There's a bunch of them. And if we get over that swing point high, and in the Fed, of course, as well, if we get over that swing point high, then you got to think you're going to test the top of the range. But realize we're still in a range trade in all these indexes. That hasn't changed. And as we get to the synopsis here, I'm going to say, hey, we're not out of the water. We'll come up to the top. We came up to this key area up here, and we failed on Friday. We didn't get over it. That's important to get over. If we get over it, it's back to the highs and more than likely new highs. And that's why I started moving back into equities. NDX, NASDAQ, they gave us a key signal that we're probably going back up there. Now if the S&P can confirm it, then I think it becomes more or less a done deal. Yeah, we'll still be range trading, but the odds of breaking out of that range to the top side probably increase fairly high. It would give us fairly high range odds. Upcoming earnings, if I look at what's out here, yeah, there's a lot of data coming out, and it's always the case. And then we're going to move into the new year here, get the fresh PMI numbers and so forth. Key thing next week, though, on economics, earnings, and the Fed. I think that's where the real stuff's going to be. Ukrainian situation geopolitically, it's a mess. They keep pressing. Russia does. Russia's in a mess, and they've got to do something somewhere, and the best place to do that, you go over and you poke on Ukraine. Let's talk about the bottom line here, because I think technically we're just that one step away from a move back to the highs. NDX comp is telling us it's probably going to happen. We just need the S&P to confirm it. We also have a risk of rolling back over as well. We're not out of the woods yet. And I want to emphasize that, because even though I began to increase exposure, it's a bet on these markets actually getting higher. I've been waiting 2.5, 3 weeks here to see what was going to happen. But it's a bet on that taking place based off of what took place in the NASDAQ NDX. But yet we're not out of the woods. Because if I pull this S&P chart back up again, and we think about a situation where it can't get over these highs, well, what's it going to do? Well, most likely it's going to come back to the lower end of that range. Remember, we've kind of got three ranges going on. You got this high, you have kind of a larger one here and a larger one, an equidistant one there. in these ranges, we're right here testing to get over it and back into the top one and probably extend it right to about an equidistant one. Because I suspect once we get over the highs, we're going to find problems and come back in. But you got to get over this spot first. So there's a chance that we could roll over and keep playing off this post-Fed bar. In other words, come back and test this lower end of it again. That's a long way down. I mean, these are large ranges. So we're not out of the woods yet. We have to watch this. We have to play it close to the vest. And we have to wait for a confirmation breakout to add more exposure. Try to get the push up into the top, right? And then take some of that exposure off and book it. But it's not a done deal, folks. And I want to show you something that, you know, some data that I've been tracking more. I haven't gone back and done the historical on this, but you can see from this, and I'm probably going to have to shrink this chart a little bit. Let me shrink this so that you can see it. And I'll just cut that title off the top here. But I want to talk about what this is. Now, you all know that, you know, I track all the trends across all the stocks in the market. This red line is bearish trends. The blue line is bullish trends. This is the S&P 500. And what I've done is I've pulled over those areas and just highlighted where the bearish trend start to outnumber the bullish ones. And so if you go back and look at this, in August last year, the bearish trends began to outnumber the bullish trends. And if you think about that, what is that telling you? Well, it's telling you more and more stocks are getting weaker. Individual stocks are getting weaker. And when that happens, you know, naturally you would think that the overall S&P 500 is going to have to go down. And that is what you saw. So as you see here, when that crossover takes place, you know, the assumption is that the crossover is going to continue, and when it does, what do you get? You get a sell-off. Here again, this time frame was late, well, mid-September, and if you remember, in mid-September, we crossed over again. We made a new high, but shortly after that, what happened? Big spill in the markets after the crossover. Here we are again, crossing over. What is this? This is middle of December. What happened there? Also sell-off. We still haven't crossed back over yet to the bullish side. Now, I didn't highlight the bullish ones because the bullish ones don't give you quite as good a signal as the bearish ones. So I'm kind of using this as a precursor, if you will, to bearishness. When we cross back over, if the bulls do cross back over, we could expect new highs. The problem is if we don't cross back over, just like back here where it took a while, if we don't cross back over, in other words, more bullish ones start to print, then I would expect that we are going to see more selling again. And so, as I was just saying, we're not out of the woods yet. We've come up, you know, the bullish ones are about even with the bearish ones, but they haven't crossed back over and shown us enough bullishness to push the general indexes back up to new highs. I'll be watching this. I'll let you know what's happening, but that's, you know, kind of a nice, I've been thinking this would be a nice indicator. I haven't really taken the time to go back and look at it historically because I'd have to recompute all the data. But I've been tracking it now for, what is this, about 7-8 months, and it's getting to where there's enough data out here to start looking at it, and it's kind of a good indicator on coming weakness, and I like the way the indicator's shaping up. So what does this tell me, though? It tells me we're not out of the woods yet. So that part of it, I think we have to keep watching. All right, let me blow this back up, and so we can read what's there and move on to the next part of this. So on another note, so that's kind of near term, right? If I look at a little bit longer term and think about what may happen with these indexes on a weekly chart, and let me pop up the S&P weekly again. And if we think about it from a weekly perspective, what may take place, there is the possibility that a push higher, well, let's talk about it a different way. Let's assume that we hold for one more week, that we hold at these highs. And I'm on the S&P 500 weekly chart. This is going to print as a swing point low if we hold one more week. And the odds that we hold one more week are pretty good. I mean, we're going to have a heck of a dive to go down here and break this. So once that prints as a swing point low, then what does that do? Well, unless we start pushing back up and start taking out the highs, what have we done? We've essentially gone sideways. And if you go sideways long enough, right, then the potential that you break here and break down these on daily time frames, right, becomes higher. In other words, if we don't start pushing higher and we keep going sideways, eventually if we see some weakness and we come back down to this level, what do we have set up? We have multiple swing points on multiple time frames that could break to the downside, and folks, that would lead to a faster, heavier, bigger decline. Not saying it's going to happen, I'm just saying the setup is finally forming again where that risk is there. So in my mind, it's critical over the next week or two that we see this S&P 500 get over this area that we were just talking about and not only challenge this high but get over the high. If it doesn't, the risk on the downside becomes heavier because the setup is there to break on multiple swing points. Now, if we were to go sideways just a little bit longer and then eventually break to the highs, what does that do? Well, that would set up the same case. So you can argue this both ways, and that's my point of saying earlier, we're not out of the woods yet. We could still roll over, but we also could break higher. So if we could inch up for another 2 weeks, let these print as swing point highs, and actually it would take 3 more weeks. Is it 2 weeks? Let me check it. I think it's actually 2. 29, yeah, it's 3. It's 3 weeks. Then you could get a stronger push to the upside. I don't think we can wait that long. So my guess is that what we're going to see, if we see it bullish, is we're going to see this market, come back up, roll up, make a new high, and then roll back down, and then, it could continue this kind of a pattern. But I don't see the strong upside move versus the potential strong downside move as a result of the multiple swing points that are going to form down here. So to me, it's critical that it take out these highs over the next couple of weeks. And then lastly, if I think about the fact that we're deep into a bull market, I mean, let's go back and pull up a chart of the S&P 500. We're 5 years into a bull market. This started in 2009, and we're 5 years into it, and we continue to press higher. We had one scare now, this one in October. Since 2011, we haven't had a big scare. I mean, we kind of had a minor one here, right? Minor ones, just like the minor one here, but they recovered quickly, went to new highs. So essentially, for what has become now almost 3 years of straight up, on top of 5 years of continual push. Bull markets usually last 3.5. We're going on 5. We're almost 5 now. That puts the MTTFs extremely in an overbought situation. And if I pull up the S&P 500, you can see we're at 92%. This is nosebleed. And I've had some longer term members, actually Phil, which is a good friend of mine down in Texas who reviewed the last book, asked me, has things changed? And yeah, they have, right? What's changed? Well, the central banks have changed. It's the central banks that have kept us on this bull run as long as they have, and it's been coordinated almost. Where, it was us, and it was China, and it was Japan, and now it's Europe. Can this go on longer? Can we get to, almost 100%? I guess if they keep flooding the markets with money and the belief is there, then yeah, I guess it's possible. But what I wanted to talk about not so much was this, as much as, we know this is overbought. What happens when this one gets overbought? Right now we're at 20%. That's the weekly bullish move that we're in now. Weekly's bullish, sideways is nosebleed. We're going to break up or down pretty soon. It looks to me like it's probably going to be up now. What would it take to get this one into nosebleed? And nosebleed typically is around 70%. So that's 39 weeks. If I do the calendar and say, okay, we're at 12, to get to 39 is what, 27 weeks? What does that put us out to? About June to August, somewhere out there. That's probably where we could see this market really struggle. And, if I think about the longer term, you're extremely overbought here. You would be nosebleed there, and potentially this might line up the same way. And when they do, that's when the real danger is going to hit. I suspect that somewhere this year we're going to see a big correction, 10, 20, 30%. And if I just look at those things I gave you now, it looks like it would be farther out in that time frame if it lines up that way. The dollar destruction of earnings, technically the intermediate term time frame getting extended along with the long term and potentially the short term all at the same time. And if we line up as we could, as I just talked about, if we line up as we may here on the short term time frame, actually I was talking about the weekly, right? If we line up to where there's swing point lows when we get out to June, right? Let's just say we don't climb all that much and there's a bunch of lows. Let maybe 2 or 3 of them line up down here. Then the risk is going to be huge. We'll tackle that as we get there, but I wanted to kind of just, set the framework for the way this thing might play out this year. Okay, I'm spending too much time on this. Let me just quickly, I want to highlight a couple things. As you know, this week I got longer. We've got some earnings coming out in all of our core positions, in particular Facebook this week, but then after that we've got NXPI and AUK and ZLTQ. So core positions still looking good. You just hold them and wait, right? ITB, I want to highlight these two, AYI and ITB. And the reason for that is I just want to show you a couple of things. I always try to highlight a couple of these. So let me quickly pop over to the portfolio, and I want to bring up ITB first. This looked great, right? We got on board, and then what happens? Earnings come out and just totally kill the sector. So what do we want to do now? Well, we know that the sector's dead probably for 3 months. We want to get out. Where we want to get out? Somewhere in that area if we can. I was thinking the bottom of this, right, somewhere in there, right, trying to get out. But if the market turns bullish, it could pull this back up as high as this range. And so somewhere up here we want to get out. We got in at a price point to where we're not going to lose too much if we get out somewhere in here. That's the idea. Try to get out of this on a push up. So that's the bad one. If I look at the good one and I pop over to, what was it, AYI. So let me grab that one. This one pushed up this week and it tested that high. 154.73. It was Friday it did it. In the trading room, the teach and trade room, which all of you have access to, if you have a chance, I talked about this Friday and told you I took some profits as a result. I can't do that in the portfolio unless I guess, because I don't know if it's going to break out or not. If you're intraday and you have the ability, you could sell some, as I did, up towards that when it showed us it didn't have the volume and couldn't stay over the high, and then try to buy it back cheaper again. The portfolio was not quite that flexible, because we only put the orders in pre-market. But in this particular case, here's a case where if you're a little bit more flexible and you have a chance to check it out, you could do the same thing I'm doing, and that is you could take some of it off here and put it back on at a lower price. Sometimes it sets up that we can do that in the portfolio. Sometimes it doesn't. This is one of the cases that we couldn't do that. Couldn't foresee that. Overall, is it going to go back up there? Probably is. It's attacking it with good volume. So if you're just patient, yeah, it's probably going to do it. But if you want to be more flexible, do watch that teaching trade room and see what's happening there. Elsewhere, bunch of initial entries. We're just getting into some stuff. Asher still looks fine. XLP got pushed back on some earnings. Earnings are a problem, and they continue to be a problem. As far as the overall market, I suspect we're going to try to break this thing out this week, probably off the Fed news. That's what it looks like. Still looks like this market's more bullish than it is bearish. We're not out of the woods, so we have to watch it carefully. But if we do break and get that confirmation on the SPX, I suspect we're going to test those highs and have a good chance of getting over them again. That's it for this week. Thanks. Sorry to be so long. I'll drop it off here and try to curtail my talking next time around. Have a good one. Thanks a lot. And if there's anything I can do to give you help, just drop me a note. See ya. Bye.